In this video, we'll delve into the world of shares, the stock market, and their interconnectedness. You'll discover the risks involved and, most importantly, how you can profit from investing in shares. Let's dive right in. Shares represent ownership in a company, making you a stakeholder in its profits. These valuable assets are bought and sold on the stock exchange, and each share comes with a specific share price determined by the forces of supply and demand. When there's widespread optimism about a company's future prospects and the belief that it will generate higher profits, more people want to buy its shares to participate in the profits. As a result, the share price increases due to increased demand. On the flip side, when many investors wish to sell their shares, the abundance of sellers leads to a decrease in the share price. Now this brings us to the next topic, the stock exchange. Think of the stock exchange as a bustling marketplace where buyers and sellers converge to trade shares. Its main purpose is to facilitate the interaction between those looking to buy and those looking to sell shares. Through this marketplace, buyers and sellers negotiate and agree on the stock's price, which is a result of the interplay between supply and demand. In modern times, this process is largely automated through sophisticated computer systems. Let's uncover the two ways to make money with stocks. Firstly, there's the potential for value appreciation. You can purchase a stock at a favorable price, hold on to it for a period of time, and sell it when its price rises, thereby realizing a profit. The second method is the participation in the profit of the company. When a company generates profits, it allocates a portion of these earnings to finance future projects and strengthen its operations, while the remaining profits are distributed to its shareholders. This distribution of profits to shareholders is known as a dividend. Now, why do many people shy away from investing in the stock market, despite its enticing prospects? One of the main reasons is often rooted in their own or their acquaintances' bad experiences with investing money. Additionally, cautionary tales about financial losses and recurring crises shared in the media can further fuel this fear. One particularly haunting example is the world financial crisis of 2007 to 2008, where global stock markets experienced massive collapses. Understandably, numerous individuals suffered significant losses and were deterred from ever considering stocks again. It's essential to acknowledge that these cautionary tales are not entirely unfounded. Investing in stocks and the stock market does carry inherent risks. One of the most prominent risks is the market risk, which affects the entire market. For instance, high unemployment rates can lead to reduced income and decreased consumer spending, ultimately affecting companies negatively. Then there is a second risk, the company-specific risk, which is inherent to each individual company. Let's examine the Enron scandal that unfolded in the early 2000s as an example. The company's executives engaged in fraudulent accounting practices, misleading investors, employees, and regulators about the company's financial health. Enron had manipulated its financial statements, creating the illusion of steady growth and profitability when, in reality, it was facing severe financial challenges. The company used complex and opaque accounting techniques to hide its mounting debts and losses. As the truth about Enron's financial mismanagement came to light, the company's stock price plummeted, wiping out billions of dollars in shareholder value. However, there are ways to significantly reduce company-specific risk through diversification. Diversification involves spreading your investments across multiple shares, thereby investing in various companies, not just one. For instance, if you aim to invest broadly in the US market, you can invest in a so-called index, which represents a diverse range of companies within that market. The S&P 500, for example, is a stock market index that tracks the performance of 500 of the largest publicly traded companies in the United States. It's also one of the most widely followed and respected stock market indices globally. By investing in the S&P 500, you can significantly reduce the risks associated with individual companies. Instead, you'll be investing in a diverse range of 500 companies operating in various industries and regions, providing exposure to the broader economy. To further enhance your diversification, it's wise to go beyond just investing in the US and consider a global approach. By spreading your investments across different regions, countries, industries, and currencies, as well as including a mix of small, medium, and large companies, you can achieve maximum diversification. Achieving this level of diversification would typically require investing in hundreds or even thousands of companies. Fortunately, you don't have to deal with the challenge of buying individual stocks if you don't want to, as there are mutual funds and exchange-traded funds that manage diversified portfolios on your behalf. Let's now take a closer look at the two distinct approaches to investing in stocks. The first approach is active investing, where you select individual companies and evaluate their potential for future share price growth. The goal is to identify companies with promising prospects. On the other hand, the second approach is known as passive investing. In this strategy, the objective is to minimize risk by investing in a diverse array of companies worldwide, spanning various industries. One significant advantage of passive investing is its efficiency in terms of time and effort required. It requires less active management compared to the analysis involved in active investing. However, the trade-off is that the results of passive investing will never surpass the performance achieved by the broader market, as passive funds merely mimic the market. Nevertheless, both individual stocks and funds offers compelling advantages compared to keeping your money in a savings account. Savings accounts have a historical track record of yielding lower returns than the inflation. Consequently, the value of your money decreases annually, eroding your purchasing power. Conversely, when you diversify your investments across various stocks for the long term, you gain access to the potential of economic growth. The stock market has demonstrated remarkable resilience, displaying consistent and substantial growth despite the occurrence of crises and recessions. Nevertheless, it's crucial to bear in mind that this representation of stocks in the stock market is a simplified version. Not all companies are traded on the stock exchange, and besides shares, there are various other financial products such as commodities, derivatives, and bonds that can be traded on these markets. Now, if you want to learn more about investing, you can find a list of videos in the description where we elaborate on various topics covered in this video. Anyway, thanks for watching. Please like and subscribe.